If you view the global economy as a whole, globalization is absolutely beneficial. But no matter how good something is, it cannot benefit everyone equally. The reason is simple. While wealth can move freely across borders, people cannot. Each country has its own economic ledger, so globalization inevitably creates local winners and losers. Some of the US's traditional industrial areas have become the Rust Belt. Do the workers there have valid grievances? Is China's trade surplus sustainable? The answers aren't immediately obvious, but they're not mysterious either. There's good research available on these questions. Let's first look at how globalization creates winners and losers. Richard Baldwin, an international economist, offers a narrative that sees globalization as a series of transformations. Each transformation follows 4 steps: transformation, upheaval, backlash, and resolution. In simple terms, new technology brings change. Change causes disruption, and some people get hurt. So they push back. Eventually, the problem is resolved, and the cycle begins again. In the past, due to poor transportation, people consumed locally made products and trade was limited. Although China had large-scale foreign trade as early as the Song dynasty, or even earlier, with production tailored for overseas orders, globalization is generally believed to have started after the Industrial Revolution. The first stage of globalization involved developed countries producing advanced industrial goods and selling them to developing countries, possibly in exchange for raw materials or natural resources. A key feature of this stage was that products were manufactured in a single location, often a single factory. For example, when Japan made a television set, everything from components to final assembly was done in Japan. It was a purely Japanese product. From today's perspective, this seems inefficient. Why not outsource simpler parts? Because back then, it wasn't possible. A TV is a complex product. Screen manufacturers needed to coordinate closely with tube producers. It was easier to manage when everyone was in the same place. But starting in the 1970s, with the spread of telephones and fax machines, and international travel becoming easier, developed countries began relocating some manufacturing steps to developing countries. That marked the second stage of globalization. For instance, Korean factories began producing components for American companies. These were often labor-intensive, sometimes polluting processes. U.S. companies benefited from lower costs and avoided strict domestic environmental regulations. Koreans were happy too. They were now part of the global value chain. By the 1990s, with the rise of computers and the Internet, communication became even easier. Developed countries began outsourcing entire manufacturing processes, ushering in the third stage of globalization, which continues to this day. This was a qualitative leap. Developing countries became exporters, and developed countries became importers. Why would developed countries do this? Because manufacturing no longer generates much profit. The money is in branding, R&D, sales, and service. On the surface, it looks like China exports iPhones to the US, but most of the profits go to Apple in America. And this creates winners and losers. Multinational corporations are winners. They can now focus only on the most profitable parts of the value chain, boosting efficiency. Developing countries are even bigger winners. They now receive core technology for free, once denied to them, and are essentially forced to learn it. Outsourcing brings not only technology, but also training for workers and managers. China quickly began creating its own brands. Trump often promotes bringing iPhone manufacturing back to the US, but that's no longer possible. You'd need entire supply chains, generational know-how passed down from worker to worker, and tacit knowledge embedded in factory processes. These aren't things you can recreate with a blueprint. The former manufacturing workers in developed countries? They've become the losers. They generate the disruption and backlash. This brings us to the second first-order correction to the idea of free trade. The issue of inequality. Globalization narrowed the wealth gap between countries like China and the US, but within the US it seems to have widened the gap between winners and losers. Is that true? Below is a famous chart showing US GDP per capita growth versus median household income growth. Before 1975, household income grew in step with GDP per capita. After 1975, GDP per capita kept growing, but household income stagnated. In simple terms, the average person stopped sharing in the country's growth dividend. I should note that, this chart slightly exaggerates the issue due to statistical methods. Still, many jobs that once supported a middle-class lifestyle disappeared due to globalization. Economists found that, when the U.S. opened up imports of a certain type of Chinese product, the American regions producing that product saw higher unemployment. Some American companies even exited those markets entirely. But notably, the same research found that, for American firms at the technological frontier, Chinese imports were actually beneficial. These firms partnered with Chinese companies, imported components, or outsourced manufacturing altogether, allowing them to focus on innovation. They became more efficient and hired more R&D staff. Overall, U.S. industrial capability didn't decline due to globalization. It actually strengthened. In 2018, total U.S. factory output was 11% higher than in 2001, when China joined the WTO. What declined was the number of workers, not total output. And of the U.S. manufacturing jobs lost, only about 12% were due to foreign trade. The rest were lost to technological change and automation. When you factor in how cheap Chinese goods improved American living standards and boosted employment in the service sector, trade with China has clearly been a net benefit. Some studies estimate that, after World War II, free trade effectively gave U.S. households an extra $10,000 in income per year, while the cost of helping those who lost their jobs due to trade was just 1/20th of that. The real reason for widening inequality in America isn't globalization. It's innovation, which is inherently a winner-takes-all game. In other words, even today, globalization is still good for the U.S. The real losers are companies unwilling to innovate and low-skilled workers. The third first-order correction to the ideal of free trade is this. Excessive trade surpluses or deficits can cause real problems. In U.S.-China trade, China runs a large surplus, the U.S. a large deficit. People interpret this in two opposite ways. One view is that, China is making money and is the winner. This is the view held by Trump's MAGA supporters. It's classic mercantilism. The other view considers that the U.S. is spending dollars. Money it prints itself, while China gives up labor and goods. Isn't the U.S. winning? Isn't it exploiting China? This view ignores the fact that, the U.S. must restrain its urge to overprint dollars to maintain its currency's credibility. A country is not a company, much less a person. You can't use household-level thinking like making money or getting a bad deal to understand global trade. You need systems thinking. The right question is, if this game continues long-term, what will happen to both sides? Historically, from at least the Ming Dynasty to the Opium War, China always ran trade surpluses. Even though China practiced isolationism, it had profitable trade routes, like the Canton 13 factories. Adam Smith noted that, London merchants could double their profits, just by importing Chinese goods. Meanwhile, China was self-sufficient and didn't need much from Britain. The British East India Company's exports to China were only a third of its imports. That's why in 1793, when Lord Macartney led a British mission to request more trade ports, Emperor Qianlong wasn't interested. China was making money. It exported renewable goods produced by labor and received pure silver in return. Why trade away silver for Britain's strange industrial products? Historians often blame Qianlong for lacking a modern vision. But few realized China was running a trade surplus. In 1998, Canadian sociologist André Gunder Frank published ReOrient, arguing that the Qing dynasty attracted huge silver inflows through trade surpluses, proving China's economic power. But that's just mercantilist thinking. It misunderstands economics. Scholar Qin Hui criticized this perspective, noting that China's most powerful dynasties, Qin, Han, Tang, and Song, all ran trade deficits. Historically, advanced regions like ancient Rome and 16th to 18th century Western Europe typically ran trade deficits. Why? Because trade demand usually comes from wealthier societies seeking luxury goods and unavailable imports. High consumption leads to high imports and trade deficits. Ming and Qing China ran surpluses because its people consumed very little. British merchants wanted to sell textiles to China, but Chinese farmers wore homemade cloth, and couldn't afford or use imported goods. Britain, by contrast, had a large class that could afford imported tea. Even if you think silver is better than tea, and trading tea for silver represents advanced productivity, this game is unsustainable. Young economist Su Jin argues in The Silver Empire that, this imbalance caused big problems for both China and Britain. Britain had to scour the world for silver to send to China. In the 1760s, 3 million taels of silver entered China annually. By the 1780s, that number rose to 16 million. But silver was finite. Britain urgently needed a way to reverse the flow. For China, silver inflows were like a monetary overissuance. In the short term, this boosted trade and economic activity. But in the long run, it caused inflation. By the time of Macartney's mission, Chinese prices were already rising rapidly. More importantly, export-led growth made China dependent. Domestic consumption didn't rise. People's lives, culture, and skills didn't improve. No industrial upgrading occurred. When India and Japan entered the tea market, China lost its advantage. This unsustainable game ended in tragedy. Britain finally found a product that Chinese people would pay for. Opium. The root cause of the 1840 Opium War was China's trade surplus. That's also the root of the US-China trade war that began in 2018. China remains an export-driven economy with insufficient domestic consumption. Only this time, Britain is replaced by the US and silver by the US dollar. But now China does something smarter than hoarding silver. It lends dollars back to the US by buying large amounts of US Treasury bonds. For the US this is great. Americans dislike saving, and China's purchases reduce their burden. This helps keep US interest rates low despite low domestic savings. Low interest rates mean cheap capital, which fuels prosperity and rising stock markets. After China joined the WTO in 2001, the US enjoyed major benefits from borrowing from China. Shouldn't the US be grateful for China's trade surplus? You can probably guess. This too is unsustainable. When President George W. Bush took office in 2001, he promoted the ownership society, encouraging citizens to own assets like homes and stocks. We've seen that middle-class incomes lagged behind GDP growth, but low interest rates made it easy to buy homes, and rising stocks gave people a sense of prosperity. Even low-income Americans could now get mortgages with minimal or no down payments. Long story short, some economists believe that China's trade surplus indirectly contributed to the 2007 U.S. subprime crisis, and the 2008 global financial meltdown. Of course, the U.S. shouldn't blame China while spending China's money. But hoarding massive dollar reserves always leads to some kind of imbalance. It's unhealthy. And it scares Americans. That's why the trade war with China is not just about Trump supporters. It's a bipartisan consensus. No one did anything wrong. Everything happened naturally. Multinational firms naturally shifted production to developing countries. China naturally became the world's factory. U.S. blue-collar workers naturally became victims. China naturally ran trade surpluses. The U.S. naturally started a trade war. Britain used protectionism to upgrade its industries. So did the U.S. China has just done the same. These things have all happened before. This is just history repeating itself. Baldwin was right. Every transformation brings upheaval, backlash, and ultimately resolution. It's all natural. History teaches us that free trade is ultimately good. But it helps to be a little proactive, because someone will always get hurt. In the end, it's best to strike a balance. Americans should reflect more on the zeroth order principle of free trade. Meanwhile, China should let its citizens earn and spend more. Some want to run China like a business. Always investing, never consuming. But that's unsustainable. The good news is, China is starting to pursue balanced trade and boost imports. The biggest winner of globalization is China. Now it's China's turn to champion free trade. That's it for today's content. Thank you for watching, and I'll see you in the next video.
If you feel there is value in this, please like, subscribe to this channel, and leave your thoughts or suggestions in the comments section. Let's grow together and read more good books.